Hello, welcome to Prime Investors channel. Today I'm going to talk about a question that is often asked to us, which is whether you should be doing a SIP in stocks. Most of you are familiar with the concept of SIP because you do that with your mutual funds, and it's a very ideal way to save in a disciplined manner over time. And many of you have been told by brokerages and perhaps your friends to do SIPs in stocks, especially if you think those stocks hold potential. You could save over a period of time. Now, do you think this is a great way to build wealth in stocks? At least at Prime Investor, we believe it's not. So I'm going to explain to you on why it's not a great idea to do SIPs in stocks. Let's dive right in.
All right. So I'm going to take a leaf out of a couple of articles written by my colleagues Aarti Krishnan and Anush Raj to explain to you on why doing SIPs in stocks is not a great idea, and in fact it can be detrimental at times. So I'm diving right in. So the idea of doing SIPs in stocks is that you think that you will reduce the risk of investing in equity by doing so. But we think while you accumulate stock over 3 or 4 installments is fine. Anything beyond that is more suited for mutual funds and not so much for stocks. I'm going to give you 4 reasons why we think it's not a good idea. First thing, we think it's all about stock selection when it comes to building wealth with equities. Basically, that means if you had picked the right stock, the compounding works beautifully for you and you're going to make money. But what happens in real world is that you are pitched the idea of doing SIP in a stock versus how much the Nifty, the index, would have returned. I'm just taking the case of a SIP in Bajaj Finance. You would have told Bajaj Finance is, by the way, a multi-bagger, and you would have been told I'm going to take more real world data to show you how Bajaj Finance would have done. For this purpose, I'm going to pick this stock and put this in our Excel sheet. Please note that this is available to you. You can check anytime when you want to on how a stock has performed in terms of SIP and lump sum. So let's get into this. I have given Bajaj Finance here for a period of 3 years. Bajaj Finance is a multi-bagger, so you know that it has delivered a lot. So between 2018 and 22, had you invested 10,000 rupees of SIP in Bajaj Finance, you will see that at the end of this period, the value is 9,80,645. Great. And the XARR, the returns that you get when you calculate for a SIP is called XARR, 34% XARR, which is fantastic. And you see the index delivering about 16%. Super. And this is what you are typically told. But this Bajaj Finance stock was a multi-bagger. And what would have happened had you invested the same sum, which you invested over a period of time in SIP as a lump sum? The data here will show you that if this had been invested through lump sum, the end value, now would have been about 23 lakhs, right? 23 lakhs as opposed to close to 10 lakhs that we are talking of had you done your SIP. Now, what really went wrong? So I'm going to go back to my presentation here. What really went wrong, as far as Bajaj Finance was concerned? What went right is that it was Bajaj Finance and it was a multi-bagger. Great. So, you chose the right stock, but, timing, right? Bajaj Finance saw a significant re-rating in its business over a period of time because it went into redeveloping its businesses digitally. It did a lot of things new and the stock saw a re-rating. Now, this, when discovered early, is when the real, power of wealth building happens, not just compounding. So in these 3 years, the money has compounded fine, but the stock underwent a re-rating. And what had happened if you had done a SIP was you would have been averaging the stock every time at higher values. So there really was no downside averaging. Of course, averaging can be both ways, on ups and downs. But then in this case, basically you were buying the stock at every higher price and you didn't have an opportunity to really, enjoy the full compounding of it. So that's one thing. So like I said, first is the business, which is what I mentioned here. If you had gotten into the wrong business, likely that, you would have been putting, good money after bad and eroding your wealth. And, the timing of Bajaj Finance really mattered. In every stock, much as we would like to say, it's all about holding, The time of entry does matter. For example, if the markets, in March 2020 gave you a wonderful opportunity to put some lump sum and you had been simply doing a SIP of 5,000, imagine how much you would have lost out by not entering into that low point, right? So March 2020 would have been a wonderful time for you to just, if had you kept some lump sum, in the sidelines to deploy them, right? I'm talking again about stocks. This is not about mutual funds where the idea is not to time the market, but in stocks to say that you cannot time the market, that essentially means you can't be in stocks. So that's the second point. Timing matters. The other, flip side to running SIPs and stocks is that you are blind to the changes that happens in your company because your investment is on an autopilot. What happens? The amount automatically goes from your account every month. You are not keeping track of the changes that happens in your company. For example, Z Entertainment was a great stock until like 2019. People would have loved it, and it's because it was a great stock, likely that many investors had gone into SIP to get into it. But the loan saga that happened, the company's loans ballooned, it had issues, paying it off. All of this led to the downfall of the stock. Now, had you not kept track of the news that was happening in this company, very high chance that, your money would have continued to go down the drain literally, because the stocks, all the stellar, returns that one spoke of went into oblivion. So it's very important to keep track of the business that your stock is into, whether there are changes fundamentally or changes regulatorily in the businesses. When you do SIPs, automatically your mind switches off from these kind of events. And it might, by the time you discover, it might even be too late, right? The fourth and most important thing, is that doing SIPs and stocks over a period leads to concentration. Sometimes, you try to do stocks, SIPs over a 3-year period, 5-year period, and you may have a long-term portfolio. So you do SIPs in certain stocks. What happens is that stock becomes a very heavy part of your portfolio. And, if something wrong happens, the hit is also very high. So the very idea of diversifying, capping exposure to certain stocks, pruning those stocks, booking profits, all of these become more complex in SIPs, right? So I just want to sum up. Very simple. With stocks, use a phased accumulation strategy for the stocks that are in your buy list. Create a buy list of stocks, maybe 3 to 4 installments, right? Not more than that. Even if you think, this is the best stock to buy, if it's the best stock to buy, trust that compounding will work beautifully. You don't need to necessarily SIP. And, avoid SIPs which may prevent you from timing your entry right. And, it's kind of, and encourage, lazy investing. So if you want to do SIPs, choose mutual funds. Mutual funds, again, the same thing happens. The only difference is you're doing it over a portfolio of stocks. So it's very different. And remember, fund managers are there to prune those stocks, book profits, etc. So they are doing that for you. But with your portfolio, it's not that easy. So you might go really, excessively on a single stock and hurt your portfolio. So that's it, folks, today. We'll come back with another video soon. Do please like our video and subscribe to it. And please check the Excel that I showed you in the article link given below. You will find it mighty useful. You might want to compare some of the stocks you hold in terms of SIP and lump sum returns. Thank you.